Welcome to Solidarity Spotlight, the place where we share with you bleeding edge stories. I'm your host, Solidarity. Let's discover what's happening today in blockchain. The cryptocurrency landscape experienced significant turbulence today as Bitcoin traders position themselves for a potential slide below the psychological $100,000 threshold. This bearish sentiment comes amid growing concerns about market volatility and institutional positioning. As evidenced by the continued outflows from Bitcoin exchange-traded funds, for the fourth consecutive day, Bitcoin spot ETFs recorded substantial net outflows, with $196 million leaving these investment vehicles on August 5th alone. Fidelity's FBTC led this exodus with $99.11 million in withdrawals, while BlackRock's IBIT saw over $77 million pulled from its coffers. The market impact of this sustained selling pressure cannot be understated, as it represents a stark reversal from July's positive momentum when Bitcoin ETFs experienced only 5 days of outflows throughout the entire month. This shift in sentiment appears to coincide with broader macroeconomic concerns and profit-taking behavior following Bitcoin's remarkable run to an all-time high of $123,100 on July 14th. The current price action around the $114,000 level suggests that institutional investors may be reassessing their risk exposure amid mounting economic uncertainties. Interestingly, while retail-focused ETFs experienced outflows, corporate treasuries demonstrated contrarian behavior by accumulating approximately 630 Bitcoin, worth over $70 million on August 5th alone. This divergence in behavior between retail and institutional investors highlights the growing sophistication of the Bitcoin market, where different participant classes employ varying investment strategies based on their risk profiles and time horizons. The continued corporate accumulation suggests that long-term investors view current price levels as attractive entry points, potentially providing a floor for further declines. The institutional appetite for digital assets received further validation through several significant developments in traditional finance integration. Acacia Research Corporation announced a groundbreaking partnership with Unchained Capital and Bold Asset Management to establish a Bitcoin-backed commercial loan strategy. This innovative approach allows Bitcoin holders to access dollar liquidity while maintaining their cryptocurrency exposure, representing a maturation of the digital asset lending market. The structure involves fully recourse commercial loans collateralized by Bitcoin with healthy interest rates and conservative loan-to-value ratios designed to protect lenders while providing borrowers with flexible financing options. This development could have profound implications for the Bitcoin ecosystem by creating new demand sources and use cases for the cryptocurrency beyond speculative trading. As more traditional financial institutions recognize Bitcoin's utility as collateral, we may witness increased adoption among corporate treasuries seeking to optimize their capital efficiency. The partnership also demonstrates how traditional asset management companies are adapting their strategies to incorporate digital assets, potentially paving the way for similar arrangements across the industry. The regulatory landscape continued to evolve favorably in several key jurisdictions, with Dubai emerging as a significant hub for cryptocurrency innovation. Laser Digital, the crypto investment subsidiary of Japanese financial giant Nomura Holdings, achieved a milestone by securing Dubai's first over-the-counter crypto derivatives license from the Virtual Asset Regulatory Authority. This regulatory approval enables Laser Digital to offer client-facing OTC services in crypto derivatives, establishing Dubai as an increasingly attractive destination for institutional cryptocurrency operations. The significance of this development extends beyond a single company's operational expansion, as it demonstrates how progressive regulatory frameworks can attract global financial institutions to specific jurisdictions. Dubai's approach of providing clear regulatory guidelines while maintaining innovation-friendly policies could serve as a model for other financial centers seeking to capture digital asset business. The competitive advantage gained through early regulatory clarity may result in Dubai becoming a regional hub for cryptocurrency, trading, and investment activities, potentially influencing how other Middle Eastern countries approach digital asset regulation. Similarly, Japan continued to advance its cryptocurrency regulatory framework, with SBI Holdings proposing the launch of Bitcoin and XRP exchange-traded funds on the Tokyo Stock Exchange. This initiative represents Japan's attempt to provide regulated access to digital assets while maintaining investor protection standards comparable to traditional securities. The proposed structure includes both individual cryptocurrency ETFs and hybrid investment trusts that combine traditional assets like gold with cryptocurrency exposure, demonstrating a thoughtful approach to portfolio diversification within regulated investment vehicles. The potential introduction of cryptocurrency ETFs in Japan could significantly impact global digital asset markets by providing Asian investors with regulated access to Bitcoin and XRP. Given Japan's sophisticated financial markets and historically positive approach to cryptocurrency regulation, successful implementation of these ETFs could encourage other Asian nations to develop similar products. This regional expansion of cryptocurrency investment products may contribute to increased liquidity and price stability in digital asset markets, while reducing geographical concentration risks. Technical infrastructure developments also captured attention, as Base Network experienced a 33-minute block production halt due to a sequencer failure. The outage began when the active sequencer fell behind due to network congestion, and the backup sequencer was not properly provisioned to handle the failover. This incident highlighted critical operational risks in Layer 2 roll-up networks that rely on centralized sequencers for transaction ordering and submission. While the downtime was resolved through manual intervention, the incident raises important questions about the resilience of scaling solutions that sacrifice some decentralization for improved performance. The Base team's commitment to implementing infrastructure changes and improved test coverage demonstrates responsible development practices, but the episode serves as a reminder that newer blockchain technologies may face operational challenges as they mature. For users and developers building on these platforms, such incidents underscore the importance of considering redundancy and failover mechanisms in their applications. Innovation in decentralized finance continued with Pendle's launch of the Boros platform on Arbitrum, enabling traders to speculate on Bitcoin and Ethereum perpetual market funding rates. This development represents a sophisticated evolution in derivatives trading, allowing market participants to hedge funding fee exposure through yield units that represent realized funding yields until expiry. The platform launched with conservative parameters, including $10 million open interest caps per market and 1.2x leverage limits, demonstrating a prudent approach to risk management in experimental financial products. The introduction of funding rate trading markets could significantly impact how traders manage their perpetual futures positions by providing additional hedging opportunities. As funding rates fluctuate based on market sentiment and positioning imbalances, the ability to trade these rates directly may lead to more efficient pricing mechanisms and reduced costs for long-term position holders. The success of this innovation may encourage other decentralized finance protocols to develop similar risk management tools, further expanding the sophistication of on-chain derivatives markets. Privacy-focused blockchain development received attention through Cardano's Midnight Network, which initiated its first token distribution phase for Night tokens across 8 major blockchains. The airdrop strategy, dubbed the Glacier Drop, targets users who held at least $100 in native tokens across Bitcoin, Ethereum, Solana, BNB Chain, Cardano, Avalanche, XRP Ledger, and Brave as of a June 11th snapshot. Uniquely, the tokens will not be immediately tradable, but will unlock over 4 randomized events within a 360-day window after mainnet launch. This innovative distribution mechanism could influence how future blockchain projects approach token launches by addressing concerns about speculative dumping that often follows traditional airdrops. The gradual unlocking schedule may encourage genuine network participation rather than immediate profit-taking, potentially leading to more sustainable project valuations and community development. If successful, this model may become a template for other privacy-focused blockchain projects seeking to build engaged user bases rather than speculative trading communities. The intersection of traditional finance and blockchain technology advanced through Stable Stock's announcement of its public beta launch for on-chain stock asset infrastructure. The project aims to bridge high-quality traditional stocks with decentralized finance protocols through compliant tokenization processes. The 3-layer strategy includes accessibility through stablecoin settlement systems, liquidity provision through tokenized stock representations, and ecosystem development through open platform architecture. This development could fundamentally alter how global investors access traditional equity markets by removing geographical and regulatory barriers that currently limit investment opportunities. For users in emerging markets who face restrictions accessing dollar-denominated assets, such platforms may provide new pathways to portfolio diversification. However, the success of these initiatives will depend heavily on regulatory acceptance and the ability to maintain compliance across multiple jurisdictions while providing the efficiency benefits of blockchain technology. Regulatory concerns emerged as China's Ministry of State Security issued warnings about biometric data collection by cryptocurrency projects, specifically highlighting iris scanning programs that operate under the guise of digital asset distribution. The advisory pointed to potential national security risks associated with foreign firms collecting sensitive biometric information, appearing to reference projects like WorldCoin that gather iris data in exchange for token distributions. These warnings reflect growing global concerns about data sovereignty and the potential misuse of biometric information for surveillance or intelligence purposes. The Chinese government's stance may influence how other nations approach similar projects, potentially leading to increased scrutiny of biometric data collection in the cryptocurrency space. For projects operating in this sector, compliance with varying international data protection standards may become increasingly complex and costly, potentially limiting their global expansion strategies. Despite regulatory headwinds in some jurisdictions, mainstream adoption continued as WorldCoin secured a listing on Binance US, providing American users with direct access to trade the controversial token. The listing comes amid ongoing debates about the project's biometric data collection practices and represents a significant validation of the token's market viability, despite regulatory concerns in various jurisdictions. The market implications of increased exchange availability typically include enhanced liquidity and price discovery mechanisms, though the initial trading periods often experience heightened volatility as supply and demand dynamics stabilize. The listing may also signal broader acceptance of identity verification tokens within the cryptocurrency ecosystem, potentially encouraging development of similar projects that attempt to solve digital identity challenges through blockchain technology. Looking at the broader market context, these developments collectively suggest a maturing cryptocurrency ecosystem where traditional financial institutions are increasingly comfortable integrating digital assets into their operations. The combination of regulatory progress, infrastructure improvements, and innovative financial products indicates that blockchain technology continues to evolve beyond speculative trading toward practical utility applications. However, the continued volatility in Bitcoin prices and ETF flows demonstrates that market maturation remains an ongoing process rather than a completed transformation. The divergence between institutional accumulation and retail selling patterns suggests that different market participants maintain varying perspectives on appropriate valuation levels and investment timeframes. This dynamic may persist as the cryptocurrency market continues to develop its relationship with traditional financial markets and macroeconomic conditions. The technical challenges faced by scaling solutions like Base, while concerning in the short term, represent natural growing pains for technologies attempting to balance performance, decentralization, and security. The industry's response to these challenges through improved infrastructure and testing protocols demonstrates a commitment to reliability that may be necessary for broader institutional adoption. Innovation in derivatives and structured products suggests that cryptocurrency markets are developing the sophisticated risk management tools necessary for institutional participation. As these tools become more prevalent and reliable, they may contribute to reduced market volatility by providing participants with better hedging mechanisms and more efficient price discovery processes. That concludes today's Blockchain Spotlight. I would love to know your thoughts. Thanks for listening, and don't forget to follow me for more spotlights. See you next time.